Markets are never wrong. Opinions often are. Jesse Livermore. Right now, the entire financial world is obsessed with one word: inflation. Every headline, every TV debate, every central banker speech, inflation this, inflation that. But focusing only on inflation right now is like staring at the smoke alarm while the kitchen is already on fire. Something else is happening in the background. Quiet, structural, and most investors aren't even looking at it. We've seen this pattern before, actually multiple times. In the late 1960s and early 1970s, inflation exploded in the United States. By 1974, inflation hit 12.3%. Investors panicked. The Federal Reserve slammed the brakes. Interest rates shot up, and the market collapsed. The S&P 500 fell almost 48% between 1973 and 1974. But here's the twist most people forget. Inflation wasn't the only problem. The real problem was something else: debt. During the 1960s, cheap money fueled borrowing everywhere. Companies borrowed, governments borrowed, consumers borrowed. Sound familiar? Fast forward, 2008. Everyone was watching housing prices. Everyone was watching mortgages. But the real villain hiding behind the curtain? Leverage. The global financial system had piled on trillions in debt, and once that debt cracked, the entire system shook. Now let's talk about today. Inflation in the United States peaked around 9.1% in 2022. Since then, it has cooled. But here's what nobody talks about enough: debt. U.S. government debt just passed $34 trillion. Corporate debt sits around $12 trillion. And global debt? Over $310 trillion. Let that sink in. $310 trillion. Now add one more ingredient: interest rates. For more than a decade, interest rates were basically zero. Money printers go brr, cheap loans everywhere. Companies refinanced endlessly. Governments rolled over debt like it was a credit card balance. But now, short-term treasury yields are above 5%. That changes everything. Because debt is easy to carry when money is cheap. But when rates rise, the interest bill explodes, and suddenly refinancing becomes painful. This is why inflation might not be the biggest story anymore. The bigger story is what high interest rates do to a debt-heavy world. Think of the global economy like someone juggling bowling balls. Debt, interest rates, asset prices, growth. For years, the system survived because one ball was super light: interest rates. Now, that ball just turned into a bowling ball, and the juggling act gets harder. Already, we're seeing pressure. Commercial real estate loans rolling over at higher rates. Governments spending more on interest payments than infrastructure. Companies delaying investments. Even the U.S. government is projected to spend over $1 trillion a year on interest payments in the next decade. That's not a small number. That's a structural shift, and the market is only starting to process it. Now, let's be clear, this isn't the prediction of doom. Economies are resilient, innovation is real, and markets have an incredible ability to adapt. But history shows us something simple. When debt gets very large and money suddenly becomes expensive, volatility usually follows. Maybe it's a slowdown, maybe it's a market correction, maybe it's just years of choppy markets. Nobody knows for sure. The point isn't panic, the point is awareness. Because while everyone is staring at inflation, the real story might be happening quietly in the background. In balance sheets, in refinancing schedules, in the global mountain of debt. And in markets, the biggest risks are often the ones nobody's talking about, especially when everyone is busy watching something else. So the question isn't if debt matters, it's when the world finally admits it. And when that moment comes, you'll want to be ready. Subscribe now.